Long gone now are the days of no-doc mortgage underwriting and interest-only loans. More than 5 years after the subprime mortgage crisis brought down the economy, the Consumer Financial Protection Bureau spelled out new mortgage underwriting laws for lenders. The rules make banks legally responsible to determine whether a borrower is able to repay his or her mortgage by complying with what the agency defines as a qualified mortgage. The law, which will affect mortgage options for as many as 100 million Americans, is meant to prevent poor mortgage underwriting standards that led to the crippling subprime mortgage crisis. So what exactly is a qualified mortgage? It essentially documents a borrower's ability to make monthly payments. Among other requirements, lenders have to document a borrower's employment status, income and assets, current debt obligations, and credit history. Excess upfront fees are prohibited, including those used to compensate loan originators. Toxic loan features like mortgages that exceed 30 years or interest-only payments are banned. And now there's a cap on how much of a borrower's income can go to debt. To get an eye into how banks will receive the new mortgage rules and how it might affect your ability to get a mortgage, we thought we'd check in with a mortgage lender. Joining me now is Lynne Pulford, head of Sandy Spring Bank's Mortgage Division, a regional bank that operates in Maryland and Virginia. Lynne, welcome to the program. It's great to have you.
Thank you.
So how will these new rules affect borrowers that you extend mortgages to?
The new ruling actually prohibits lenders from being able to make loans to borrowers without ensuring that the borrowers have the ability to repay the debt. I don't believe in our situation that's going to change too much. We make sure when we actually receive an application from a borrower that the borrower in fact can make the payments on the mortgage prior to approving the loan.
So the new rules are intended to enhance consumer safety, but will it cause Sandy Spring Bank to tighten credit and make mortgages even harder to get? Or on the flip side, having these guidelines in place, will it actually ease some of the tighter credit that we've seen in the aftermath of the subprime mortgage crisis?
I don't think that we'll see that it will tighten the credit in general for borrowers. There are 8 credit factors that come into play when in fact you're qualifying a borrower for a loan. One of those is the debt-to-income ratio that you had mentioned. That debt-to-income ratio is 43%. There may be some borrowers that in fact would be able to make the repayments on the loan, that the 43% debt ratio might present a problem. But for the most part, I don't believe it's going to tighten or loosen the credit underwriting guidelines that we have in place today.
The other thing that we've seen, Lynne, in the aftermath of the subprime mortgage crisis, that the process of obtaining a mortgage has been a lot slower because banks are requiring a lot of documentation from borrowers so that they can show that they can repay their mortgages. Do you think that the new rules will actually help speed up the process?
I don't see them speeding things up. In fact, it may delay the process. There is an obligation in this ruling to ensure that some of the credit verification factors are done by a third party, and that in fact could delay the process some. But in general, if you think back to prior to the boom years, we're back to requiring the documentation to ensure that the borrower can repay the debt. So although it feels like reams of paperwork, it really is back to the way that we used to document files to ensure the repayment on the loan.
Yeah, the new rules stipulate that a qualified mortgage can't have risky loan features, as you and I have talked about, such as terms that exceed 30 years or interest-only payments. Will the new rule limit the type of mortgages Sandy Spring Bank would otherwise extend to a 30-year fixed-rate mortgage?
No. Today we don't offer any of the loans that are qualified under those riskier loan types, so they will not affect the loan products that we have to offer to our borrowers at all.
Would you extend mortgages that fall outside of the so-called qualified mortgage definition?
It's too soon for me to comment on that. It's 800-page ruling, and there's still some clarification that we would be hopeful to receive from the CFPB prior to it actually going into effect next January. I'm not really sure what the overall additional risk or obligation on the lender's behalf will be on loans that fall outside of that qualified mortgage. So we'll have to get a little more information before we can make a determination as a company as to whether we'll offer that type of loan.
Are the new rules likely to phase out the adjustable rate mortgage?
I don't think it will phase out the adjustable rate mortgages with a 5-year initial term or greater, but we may possibly see the 1 and 3-year ARMs phase out. That would be because there is an obligation to qualify the borrower for the highest payment in the first 5 years that the mortgage is in existence. And so I could see that that may become less attractive on a 1 or a 3-year ARM.
It might be too soon to tell, but what do these new rules mean for you as a lender? How would it affect your profitability, Sandy Spring Bank's profitability within the mortgage division?
Yeah, too soon to tell exactly, but we do know that by requiring that more of these credit factors are verified by a third-party vendor, that's going to affect the profitability. The cost of production of the loan will increase.
And before we wrap up, how will these new rules affect the housing market?
How will they? Well, I think how will they affect the housing market? It's just simply going to be that borrowers that are not able to make the repayment on loans are not going to be able to actually obtain the loan. So the days of no doc loans and no income loans have gone away. That would be the way that it will affect the housing market. But I believe that it will ensure that borrowers are able to repay the payments on the mortgages and enjoy homeownership.
Lynne, thanks so much for your insight. I so appreciate it. Hope to see you soon.
Thanks for having me on.
Lynne Pulford, Mortgage Division Manager for Sandy Spring Bank.